Three, two, one, let's jam. Hello and welcome, everyone. I'm Corey Hoffstein, and this is Flirting with Models, the podcast that pulls back the curtain to discover the human factor behind the quantitative strategy.
Corey Hoffstein is the co-founder and chief investment officer of Newfound Research. Due to industry regulations, he will not discuss any of Newfound Research's funds on this podcast. All opinions expressed by podcast participants are solely their own opinion and do not reflect the opinion of Newfound Research. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of Newfound Research may maintain positions in securities discussed in this podcast. For more information, visit thinknewfound.com.
Scott Phillips is just the second independent trader I've interviewed on this show. Like many independent traders, Scott found that his constraints, including the size of his capital pool, the ability to execute trades efficiently, and a lack of supporting infrastructure, made trading anything but loose pants trend following almost impossible in traditional markets. These constraints led Scott to look for easier markets to trade, markets where the edges were so big they could survive inefficient implementations, all of which brought Scott to crypto in the late 2010s. While our conversation is at a high level mostly about trend following, we spend a lot of time discussing what makes trading these markets unique. For example, with tens of thousands of spot cryptocurrencies, how do you choose what to trade? How do you choose which venues to trade when liquidity is so fragmented? How do you deal with the fact that both crime and degenerate gambling are real idiosyncratic factors? More than anything, painted between the lines, Scott provides a masterclass in thinking about edges. I hope you enjoy my conversation with Scott Phillips. Scott Phillips, welcome to the podcast. You have been on my list of targeted guests for a good year plus now. Your name comes up a lot. A lot of people ask me to have you on because I think not only do you have maybe one of the most interesting, unique backgrounds getting into this space, but you are deep in the weeds of applying trend following programs in the world of cryptocurrencies, which is its own unique Wild West, and I think bears a lot of interesting and unique factors out as to how you have to approach this. So I'm very excited to dive into that today. But as I alluded to from the get-go, you are someone coming at this space from a totally different background, which I think could be likely a podcast in and of itself. But maybe you can catch me up as to how you came into this space originally.
Sure. It's a great honor to be here. I'm obviously not anywhere near the caliber of your usual guest. I'm a retail guy and a retail trader who's just gradually upskilled myself by starting with really simple systems and then gradually upskilled myself to better and better systems. And so we have this weird story of my life, which I'm kind of wary of getting bogged down in. And the short version of that is that I lived the kind of life where getting arrested or going to jail wasn't unusual. It was just like a normal Tuesday, and I was more or less a career criminal. And the Australian justice system is super lenient, like really, really lenient. But my last stint in jail, the judge made it pretty clear that he was doing me a big favor by giving me 5 years instead of probably the 15 that I deserved. And if I didn't smarten up, I was going to get the big one next time. So I was like, you have to go straight. And I went broke while I was in jail the last time. So I was getting out of jail in middle age, broke with all my possessions in a shoebox. And I walked out of maximum security prison in 2007. And my absolutely idiotic idea was I was going to go straight and become a retail trader because I knew a successful stockbroker who was my best friend. We all know that's like the worst possible idea that anyone could have and the worst possible thing you could do. And no one should ever, ever, ever do what I did. And this is where it gets kind of interesting. My story is that I tried a lot of different approaches as a retail trader, from garbage technical analysis-y type things to lots of different systematic approaches. And they were all unsuccessful except for loose pants trend following. And the reason for that is that loose pants trend following systems are really, really forgiving. Like if you manage to blow up a loose pants trend following system, you have to be really dumb to blow up. And so I did this from 2012 to 2019, and there was a multi-year drawdown that really sucked my soul away. In 2019, I realized I wasn't adding anything to the process, and a manager could do it better. And as a trader trading with a little bit less than $1 million in capital at the time, you're still a bit suboptimal in TradFi trend. But just because of the nature of single contracts, there's still some stuff you can't trade. You can't trade certain bonds and blah, blah, blah. And so I found a trend following fund that was doing the closest to what I was doing, which was very fortunate because they're much better than I was at it. And I looked for an easier poker table to sit at. And I had this feeling, I'd been involved in crypto on the edges for a long time, but I'd poo-pooed it. I'd always I trade real markets. I'm not this tinker toy kiddie market garbage stuff. And in 2019, everyone hated crypto. It was just toxic. And I just had this idea that, wow, it's so toxic and so embarrassing. And I asked all my pro trader friends who wants to help work with me on a new system for crypto. And no one was interested. And so I pivoted hard to crypto. And what I did is I took a system of Andreas Klenov's. He's got 2 books, one on trend systems, one on stock momentum systems. And I used his stock momentum system, but with weekly execution and the top 5 cryptos. And what we were doing, it was the simplest system you could possibly imagine. And it just worked amazingly well because we were fully invested in 100% long in crypto in the strongest cryptos through the 2020 bull market. And it was running at 1,000 volts, something stupid like that. And I didn't know any of this at the time, right? I didn't even understand. And so we progressively worked from there. I realized that we made quite a lot of money in that. And I figured I better put the money into building better systems. And right now we're at, I guess you call it probably decent vol-targeted CTA trend following with mediocre execution. My execution is not particularly good, and we're adding more features into the mix. So right now, in test, almost ready to go, probably today or tomorrow, is cross-sectional momentum and cross-sectional carry. And cross-sectional carry works quite a lot better than time series carry for reasons I can dig into. And right now, what I'm doing is I'm putting all my trend systems on chain on the Hyperliquid layer 1, which is brand new. And I'd like to give people instant one-click access to on-chain, no KYC trend exposure with instant liquidity on the Hyperliquid blockchain. I think that's a really worthwhile thing to do, so that's what I'm building out. Crypto trend has a big advantage if you're trading regular trend, is that crypto trend is not correlated to regular trend at all. So the big advantage of regular trend is that it's non-correlated with stocks, and the big advantage of crypto trend is it's non-correlated both with stocks and with regular trend, which is pretty cool. And the other advantage is that it's so capital efficient because some of these assets, 1,000 volt and 2,000 volt and 3,000 volt assets, you don't need to use very much of your capital. So the counterparty risk, which is huge in crypto, which is largely what you're monetizing, you don't have to leave that much on exchange.
I'm excited to dive into all that. My guess is there's a good 90% of my listeners who have no idea what you mean when you talk about bringing your process on-chain onto Hyperliquid L1, creating a vault, giving a single-click access with no KYC. And so I want to come around back to that at the end of the conversation, because I think that'll be a fun place to end. So here's where I want to start. I want to work backwards, if you'll allow me. You started to get into it a little bit, but what does the program look like as it stands today? More specifically, what are you trading? What's driving those decisions? How are you building the portfolio? And then I sort of want to reverse engineer your thinking that got you to that point.
So where we're at today is what we call CTA style vol-targeted trend following. So what we're doing is we're taking our signal, and that signal is a blend of a bunch of different, very standard looking, except for one of them, trend following features, pretty much the same as every other firm does. If that signal is positive, we're going long. If that signal is negative, we're going short. If that signal is bigger, we're going more long, up to a point where it's capped. And the usual way is to either cap it or apply a sigmoid function to it. Very standard stuff in the trend following world. And then what we do is we work out a target volatility weight. How much volatility do we want to take? And we take the exposures based on an inverse volatility weighting that are going to give us the exposures that we want. And what I started with back in the day, I actually started trading this live without doing any backtests. So what I did first is I started with Rob Carver's EWMAC and breakout features. And because I didn't understand the maths well enough then to understand why you would choose different look-back periods, I just used his parameters. And I think it's important to credit Rob. If it wasn't for Rob, I'd be nowhere. I didn't use his code because it's not for crypto, but I used his breakout feature, his moving average features, and I applied them equally weighted, and we traded it straight in production with no backtest at all. And we didn't do a backtest until we were about a year and a half in. And this is surprisingly good.
Let's talk about surprisingly good, because in our pre-call, You said, and this is a quote, crypto has a risk curve where you make 1,000% once every 5 years, and then you get hammered in the other four, end quote. And your goal was, quote, to shift the risk curve to a Sharpe ratio of about 2. And I think a lot of people in TradFi would kill for a Sharpe ratio of 2. But it sounds like you think of trend as a way maybe to manipulate the return distribution rather than necessarily a strategy with an edge. So my question to you is there an edge here in applying trend, or are you just manipulating this risk curve that exists?
There's definitely an edge, and there's edges all over the place in crypto. My view is I'm not actually sure if trend following is a risk premium or not, but it certainly behaves like a risk premium. If you think about how risk premium behaves, like they all have this awful sort of horrible tail in them, whether you're talking about value, whether you're talking about carry, it's got this awful negative skew. So what would I look at to say is something a risk premium? I would say, is there academic evidence of it? There's a lot of academic evidence for trend, starting with the 1993 Jagadish and Tidman thing. And, it's beyond doubt that momentum and trends are a real thing academically. Does it work across markets? Does it work in FX? Does it work in bonds? Does it work in stocks? Does it work in commodities? Yes, it does. Does it work in every country in the world? Yes, it does. Has it worked for over 100 years? Yes, it has. In fact, the very first price series we have, before there was even money, like 5,000 years ago, the first human city they dug up in like Iraq, they found all these tablets. They used barley instead of money, and they found price series of barley back in the day, and it exhibits trending characteristics. So trend's been around a long time. And the last thing that I would look at is other people making money from it. And people have clearly made money off trend, value, carry, all these normal things. And there's just more risk in crypto. There's more risk. There's career risk. There's counterparty risk. There's smart contract risk, there's hacking risk, there's quantum computer risk, there's all kinds of risks that no one's ever even considered, even getting involved in crypto, as well as the obvious scam risks, like you're going to get scammed here and there. But apples for apples, the risk premium in crypto, between everything that we've tested or done, is between 2 and 2.5 times better than the TradFi equivalent. And so CTA style trend works out to be reasonably done. I'm not even talking about well done. Like if you did what I do perfectly, you'd be up well over Sharpe 2 and probably with size. But the way that I do it, our 4-year Sharpe is 1.7 with retail level costs. So cross-sectional momentum is a little bit better than that, but you don't have the really nice positive skew of trend. And cross-sectional carry is about a Sharpe 1.7 as well and slightly orthogonal. So you blend the three of them together and then you're at Sharpe 2 easily. And without even good execution. Like if you strap decent execution on that, then you increase your capacity and blah, blah, blah. So yes, it's an easier poker table to sit at. And it's only easier because almost every one of your listeners who are listening to this now will be going, yeah, but it's still crypto. It's still this scammy market. I'd never do that. It's embarrassing. Like you wouldn't want to be a professional trader. Like I've had some awful Christmas dinner discussions with my family. So how about them Bitcoins, hey?
Well, I'm sure around this Christmas, it was your best trade was long fart coin, which that much worse, which sort of leads me to my next question, which is when we think about applying a lot of these, whether they're risk premia or just style premia within traditional finance, you're applying them to a fairly well-defined universe. And when we look into the world of crypto, there's very little friction for what it takes for someone to launch their own cryptocurrency. There are tens of thousands of different spot cryptocurrencies across different chains. Even if we limit ourselves to perps trading on chain or on the major centralized exchanges, there's still thousands and thousands of them. So how do you think about culling down your investment universe, either when you're running these tests or trading live in production?
At the heart of the big idiosyncrasy with crypto is that there's a size factor. So what I mean is that trend works much better on Bitcoin than it does on Ethereum, much better on Ethereum than it does on Solana, and so on, so on, so on, so on. And this holds through whether you measure it by average daily volume or open interest or market capital. This decile is a little bit better than the one ahead, a little bit better than the one ahead. And it works whether you measure it by volatility too. So unequivocally, trend works better on larger size and lower volatility coins. So what that means is that by the time you get about a third of the way through your list of cryptos, not only are we not exhibiting significant trend effects, those trend effects turn negative. So almost anything small not only doesn't have trend effects, but it has negative trend effects. And if you wanted to describe a negative trend effect, you would describe it as a pump and dump, right? So intuitively, we know that to be true. And in the same way that you find a lot of edges in small cap stocks that are very difficult to monetize on the short side, there's edges all over the place in crypto in very capacity limited shorts or things that you can't short. And you find these edges are monstrously magnificent for the retail trader. Like if you were a retail trader and a grinder, even if you can't do maths, like you can find edges in crypto that'll curl your toenails. Like no shit, curl your toenails.
So once you take this size effect into account, how much diversification is really available in crypto versus, say, I just run a naive trend program on Bitcoin alone? How correlated would a diversified trend program be and look to versus just naive trend on Bitcoin? Does Sharp really scale with the number of markets that you end up trading?
So the math still holds that returns scale with the square root of independent bets, right? But the size factor and the market factor mean that if the crypto market goes up, almost 90% of crypto is going up. If it goes down, 90% of crypto is going down. So you can make trend work on a very, very large universe within crypto, but you have to have beta models adjusting for that, which means a Barra axiom type thing. If you go down that route and you have decent beta models, you could trade everything where you're not above, say, 3% of average daily volume, like if you had decent execution. But then you need a risk model because you're shoving it all into your MVO, and you certainly don't want your risk model accumulating too much of some shot from nowhere garbage trash coin that's just spiked 10,000% on a Trump announcement or something like that, right? So for practical reasons, I'm here as someone who started with an equal weighted, no portfolio management, nothing system, and gradually worked my way into something better. Trading systems become really hard to diagnose and hard to reason about at a frightening rate. So if you're going to whack on beta models, then you have to whack on a risk model, and then you're doing this, and then you're doing that. And then all of these things require people to babysit them right. You know, I have a team of 6 devs and a researcher. So I think it's more like not could you make trend work on an expanded universe? It's more like should you? So if you're doing the first example that you said, like just do Bitcoin and Ethereum, there's probably not that much difference. In fact, we both have a mutual friend who runs half a yard of just Bitcoin and Ethereum CTA style trend following at a Sharp ratio, which would absolutely shame Rentec. But you're assuming stationarity. Like there's been 100 Ethereum killers. What if one of those Ethereum killers actually killed Ethereum? Or you're going forward, Ethereum looks like it might die now because it's got leadership issues and technical problems and better competitors. If you just bet on Bitcoin and Ethereum, well, that's a bet that I don't think you have the basis for saying that MySpace is going to be the premier financial network or that Yahoo is going to be the best search engine or any of those like tech examples. Like that's not a bet that you should take. So what I personally do is I do the top 50 because it's a reasonable compromise that looks not a lot different than doing it properly. And in a practical sense, if you're talking about directional CTA style trend, what is the effect of having your exposures not exactly right? Probably means that your volatility target is going to overshoot a little bit when the market is really trending. So in a practical sense, if you run a crappy trend system, and mine has been crappy at various points, what you're going to do is you're going to be overweight the garbage stuff in the middle of the pump, or you're going to be overweight the garbage stuff short in the middle of a dump. And both of those aren't necessarily the worst things in the world, right? The big thing about trend following is that if you're going to trade trends, either you get trends or you don't. And if you don't get trends, no amount of math can fix that. And that's something that people don't seem to understand is that trend is like the weakest edge that's still an edge. And if you get trends, those trends are probably going to be so strong that you could trade trend on crypto with a potato. So let me give you an example. Here's a Sharp 1.4 system rules. Write this down. Go long equal weight every coin that has made a 20-day high within the last 5 days. That's it. If it's made a 20-day high within the last 5 days, go long, equal weight. That's Sharp 1.4 in crypto. So if you get trends, crypto is really, It's the same poo rolled in a different colored glitter. And you have to be at a certain size and sophistication to make it make sense. Like, we all know what the platonic ideal of a system is. Like, it would be something like Gappy's system in his books, right? And he's a mate and he's offered to help. And if I start building a Gappy system, then I need a team of people who are super smart to maintain it. And then it goes wrong and I can't figure it out because I'm not smart enough to figure out where the MVO got in some weird inputs and gave some weird outputs. And what I'm big on is 80-20 solutions. And I took this from Rob Carver. So my system's a little bit more sophisticated than the one described in his books, but his books are absolutely the limit of what a single person can do. Like, he's got absolutely Chad solutions for everything, where he's not going down academic nerd holes.
So you mentioned this idea of the limit of what one person can do, but we are talking about markets here that trade 24/7 and can move incredibly fast. A positive trend can turn into a 75% loss overnight. So when we talk about trend programs, what sort of speeds are we talking about here? Are these intraday trend, multi-day trend? What sort of infrastructure do we really need to support these speeds?
Daily execution is totally fine. So the usual way of doing it is to have target exposures, what your trend features say that you should be exposed to, and then the exposures that you have now. If trading was free, we trade continuously towards our ideal exposures, right? But trading's not free, so we want to minimize our trading because otherwise trading costs are infinite negative sharp. So you put a barrier, and the barrier could be simple or arbitrarily chosen, like 10%, or my smart friends tell me that it's a benign curve fitting thing to run a bunch of back tests and work out the optimal, which is what we do. And so you work out an optimal barrier width, and once a day execution is fine. Intraday trend following, our system turns over the book around 20 to 25 times a year. So if you want to move up to running the same features but turning over the book every day, that would be better. But I would have to have execution good enough to turn over the book every day without losing money on that. So essentially what I would need to do is strap a market maker and hope to buy somewhere a little bit worse than mid-price on average and get top-tier fees and potentially rebates and basically strap a market maker to a trend. And what we see is that if you plot how predictive these signals are, they're most predictive one day out. And even 14 days out, it's still better than a coin flip. So the advantage of trend is that it's a very slow converging edge. So if we compare to, say, relative value strategies, you have to be very, very good at execution. Otherwise, you can't compete, and you're competing with price inefficiencies against the stat arb guys, and they just eat you for lunch. But because trend is so slow converging, this is why trend is so easy to trade, because you've got 2 weeks. It doesn't matter if you delayed execution by a day, actually, which is why you see a lot of the old school trend followers poo-poo the more modern methods, because they have no need for it, because the old stupid stuff from the 80s still works just fine.
So I want to push you, if you'll allow me, on back to the trend speed concept, right? Because in traditional markets, you read the academic papers, it talks about, well, let's look at a 1-year trend. These are multi-month trends, and the expected evolution of where trend applies is maybe over the next month. My perception in crypto is the markets move a lot faster than that. Your example of looking at, I think it was 20-day highs, for example, and rotating, you get a decent amount of turnover, and you're talking about faster moving markets. Can you still look at long-term trends in crypto, or do they tend to be much shorter-term trends by nature?
I started out saying that I didn't have any business having any dog in that fight. So I threw all the long-term trends into the optimizer and let it figure them out. And recently, I've just realized that we have 4 years of evidence that long-term trend just doesn't work on crypto. And my professional peers at actual firms tell me the same. Like, I don't know why, but yeah, we pulled all the long-term stuff out, and it's a little bit shorter.
Well, that sort of brings me to my next question, which is, given that crypto is such a rapidly evolving space, how do you think about the feature selection aspect of running your systems?
I don't think you can say that breakouts are better than moving average crossovers, are better than this, are better than that. You can say they're slightly different, and you want to blend a few of them together, and with diminishing marginal returns. And if you think about what's going to happen if your feature is, say, the distance between two moving averages. Let's say it's the difference between a 4 and a 16-day moving average, and you're applying it to Bitcoin and you're applying it to some garbage coin. and the market goes up, so the market has bumped them both up, your garbage coin is going to artificially show you a higher trend score than Bitcoin, right? So that's not really real. And we know that the garbage coin actually trends not as good as Bitcoin. So there's definitely an advantage to scaling all of your time series at a constant volatility so that you're comparing apples for apples, vol normalizing it. So the smart thing to do with crypto, the biggest 80-20 modification is not going all the way down the rabbit hole with a Barra, Axioma, beta model. It's just vol normalizing your features. And you don't need that many features. Like all the standard ones are fine. Better by a long way is Bollinger Bands for some reason, which I can do.
That was going to lead me right to my next question, because you said that in our pre-call, which was that Bollinger Bands were something that did seem to test in a significantly more predictive manner than other naive features in crypto. I suspect the reason why is related to something you just said, but I'm curious if you have any thoughts as to the case as to why Bollinger Bands ultimately were more predictive in your tests.
Well, they kind of led us down a rabbit hole. And by the way, almost everything I know about trading is from my great friend, the robot James. You should all be following him on Twitter. He's probably the best trading vulgarizer of complicated trading concepts into things that a dummy like me can understand. And if I sound smart, it's probably because he's taught me some stuff and he helps me with the design of my systems and he's got a share in my company and he's a wonderful man, exactly like you'd expect. So he was measuring internal correlation of our feature set and he found out that the Bollinger Bands, distance to standard deviation Bollinger Band, had significantly more internal correlation than our other features. And what he found is that when you took it to all of our other features and vol normalized it, because Bollinger Bands are calculated with standard deviation, which is a dodgy proxy for volatility, and well, it's not really dodgy, but all of our features, from breakouts to moving average crossovers to normalized momentum, Bollinger Bands, everything becomes more predictive when you adjust for volatility first, which is something that professionals really knew, because I was really excited when James and I figured this out. And then we told macrocephalopod, and he's like, oh, yeah, just assume that you knew that. And there's like 100 things that we talked to Seth. And he's like, oh, yeah, I just thought everyone knew that. And so we've given up. We spent a month on one thing. And then when we figured it out, we realized that Seth had told us it in passing, the exact answer to the thing. And we just like skipped over it. So there's a bunch of things like that. And I learned to trade off FinTwit. And the smart people, the Gappies, you, macrocephalopod, James, you and Sinclair, like you guys all taught me to trade.
I think I've had just about everyone on that list on my podcast except James. So he's up next.
Oh, you should. He's a wonderful man. And what we find is that when we vol normalize our features, they're more predictive. And this holds right the way through if you slice them up by volatility deciles. So this holds through from the least volatile coins, the Bitcoins and Ethereums, holds through way down to the shit coins. And it improves every feature and it's just a good thing to do. And it's a way that gets you close enough to the proper way of doing things that you don't need to go down the rabbit hole of beta models and risk models and so on and so forth.
Somewhat related to the idea of breakouts, and you mentioned this term very early on in this episode, was this idea of what you would call loose pants trend systems versus, which are sort of the more traditional models of trend following versus the more mathematical volatility targeting approach. And I wanted you to spend a little time, if you would, talking about the differences of those approaches, maybe both philosophically and mechanically, and which you prefer as it relates to crypto.
Sure. That's really interesting. I have traded and I continue to trade. All my TradFi trend money is in a loose pants system. So I got some perspective here. Some of the loose pants guys are very religious about it. Like if it wasn't mentioned in the Holy Book of the Turtles, it's not true trend following. And there's all kinds of purity tests. And they have a Friday night Twitter space where they rail against the evils of volatility targeting. And it'll just melt your brain with how dumb it is. So let's talk about loose pants systems first. So the big pro of a loose pants system is that you can run it from a spreadsheet. And I have run it from a spreadsheet. You don't need a research department of any sort. You can kind of keep mental track of exposures in your head. When I was running loose pants myself, like I'd wake up, get some coffee into me and flick through 5 screens on my charting program. And even without like running the spreadsheet, I kind of know what my exposures were. And it's very, very simple stuff. And when I described typical loose pants firms to you and Sinclair, the first thing he said to me was, what do these guys do all day? This is like 5 minutes a day work for an intern. And that's a pro. So let's talk about what a loose pants system, sometimes called a one entry, one stop system. The signals are usually binary. They're all in or all out. So this is the first inefficiency because you're assuming that you have no information. If you're going in on a 50-day breakout or a 16-day moving average crossing over a 64-day moving average and then back out at the other end, you're assuming there's no information in the continuous signal, which isn't true. So the signals are binary. There's one stop loss. That's the defining thing. So either a hard stop loss in the order book, which is very suboptimal for obvious reasons because people can hunt your stops, or a soft stop, which is if it closes below this level, we're going to get out tomorrow on the open. And that's the way most people do it because there's about 70 basis points of improvement in TradFi just from doing it that way. Typically, these systems don't trade intraday. Once a day execution or even less is actually fine. And so a bog standard loose pants system, my system, is a 50-day breakout entry with a 70-day low stop. That's it. Run it on a diversified set of futures markets, 40 to 50 futures markets, as many as you can afford. You've got a problem as a retail trader. You don't have enough margin to trade as many markets as you want, so you have to pick and choose. It kind of sucks. Or 70-day entry, 90-day stop, 100-day entry, 120-day stop. You get the idea. So the other common choices for stop losses are multiple of average true range, usually somewhere between 4 and 5 ATRs. And you'll notice that the terminology that these types of systems use, breakouts and moving average crossovers and average true range, it's very clearly got a lineage from the retail technical analysis-y world. It's very clearly not a quant finance derived thing. So these guys kind of evolved on their own. It's a completely separate ecosystem. So a better, more sophisticated loose pants system, like if you were going to build the best loose pants system you could, you would base your exits on a probability distribution implied by the options price. That's the smart way to do it. Anyone who's not doing it that way is suspecting. The problem with these systems, if you're getting long on, say, 50-day breakouts, sometimes you're going to have a lot of breakouts, like in a 2008 or 2020, everything's broken out. And sometimes you're going to have not many breakouts at all. So your risk, how much risk you're taking, in 2022 or 2020, your 25-vol TradFi loose pants system was probably taking 200 volts of risk, right? Just because everything broke out. And the loose pants guys would say this is not a bug, this is a feature. Like when we get a 2008, we want to be short everything, and we want to be short everything in 10 times the normal size, and because outliers. They kind of have a point. And the point is that if you want to absolutely maximize the amount of convexity that you have for a portfolio, the amount of money you make in a 2008 or a 2020 or a 2022, then you would want to take more risk when the shit hits the fan. And this is probably more so if you're looking at it from a portfolio total basis. If I'm long a lot of stocks and we get a 2008, I really want my trend following to be running at 200 volts while my stocks are taking it. You know what I mean? If you think about that in the context of a 2008, you can see how frightening this could actually be. It's easy from the cheap seats to say, I would hold that, but a lot of trend following managers pussied out in those times and reduced exposures. And so if you're looking for a trend following manager for TradFi, you should be looking very hard at those stress situations and say, did you stick to your rules or did you pussy out? And that's something that you're not going to get the right answer from a lot of trend managers. The second problem that loose pants systems have is they don't manage exposures once you're in them. So if I want to take 50 volts of risk, I need to have a certain set of exposures. So the volatility and market changes, a quant would say we have to take some risk off, and the loose pants guys won't do that because they're wanting to maximize outlier wins. So, like in cocoa this year, so cocoa was like a 20 bagger in price, but the volatility went up 40 times. So these guys are holding it like 100 times the size that Cliff Asmus would hold it, right? So those guys made their year off one trade. So that's the good news. And I got some cocoa this year. It was a great win for me. But the bad news is that convexivity, that positive skew that you're manipulating isn't free. It comes at the expense of sharp. So this trade-off between how much convexity you get and how much sharp you have, and by accepting random exposures that the market wants to give you, both in the number of trades you take and the size of the trades that you're taking, you're sort of by definition introducing luck and variance into your results. And if it wasn't for bad luck, I'd have no luck at all. Luck is not really your friend. And it's not really the end of the world taking random exposures, like all things being equal. it will reduce risk-adjusted returns because you're taking what the market gives you instead of actually choosing what you want to take. And I think that's a period, full stop, end of story kind of thing. And the next problem that you run into as a loose pants trader is that you choose 50-day breakouts, but a 20-day breakout would have got you into the same trend earlier with a larger position, which you're not adjusting. So that's a big, if you get a 500 bagger and you got onto it a week earlier with triple the size, it's a big difference to your yearly results. And this is one of the reasons why there's so much manager dispersion in trend, by the way. So you're taking parameter risk, and parameter risk is a risk that you're being paid. You're not being paid to take, but you're taking anyway. So the usual way of ameliorating that is to blend 3 or 4 different loose pants systems together to get an approximation of a single continuous system. And that's the usual way of doing it. And then the last problem is that when you're using binary signals like breakouts or moving average crossovers, you're implicitly assuming there's no information in a continuous signal. And we know how to test that. We can test that with centiles or deciles. And we know for a fact that a continuous signal has predictive power, in that a strong negative signal is better. It predicts more of the short side than a weak negative signal, and a strong positive signal predicts more of the upside than a weak positive signal. So we know that there's information there, and you're throwing all that information away as a loose pants trader. You're saying that doesn't matter. All I want are the outliers. So loose pants systems in TradFi are sort of in the range of 0.4 to 0.6 sharp, would you say?
That seems about right to me.
The continuous vol targeted are in the range in TradFi 0.7 to 1.3 sharp, depending on if you do alts. And so it's a big difference. It's a big difference in risk-adjusted returns, but the loose pants guys would say we're not playing the risk-adjusted return game. We're playing the absolute return game. And they also say that Sharp doesn't accurately measure what they do, which is nonsense. But there's a kernel of truth in that. And the kernel of truth that the loose pants guys, not all of them know it, if you bucketed the winning and losing trades of a loose pants system, the winning and losing trades would look like 2 totally different systems. So on average, the winning trades have 4 times the vol of the losing trades. So the loose pants guys are like, well, who cares about having high vol on a winning trade? And, there's some truth to that. There's definitely some truth to that. Where it turns into nonsense is that they talk about outlier hunting as though there's some sort of Nassim Taleb magic and no one's figured out that there's tails of a distribution, and everyone else is just assuming that markets are Gaussian normal, which is something that no one ever in markets has ever assumed, and no one believes it, and blah, blah, blah. I'm kind of interested in your take on that, because you've done both.
Well, this is an interview of me. I think one of the things we've seen over time, right, as we've seen the increased, dare I say, quantification of the strategy, is it is one of those cases where for this strategy to become institutionalized, it had to have a more predictable return stream. And so you got to this vol targeting approach, right? And I think there are, as you pointed out astutely, the pros and cons, which is the vol targeted approach is going to create a higher Sharpe ratio at the cost of convexity. And so you can make an argument that the higher convexity product actually might be more attractive when you're considering total portfolio construction, as we all should. That's how we should be thinking about it. But the reality is every stakeholder in the world is scrutinizing at the line item level. And so behaviorally, I think most people can probably stick with the vol targeting programs. And I think Cocoa is a great example where you saw all the vol targeters who traded Cocoa were selling Cocoa down as Cocoa was going up for the exact point you made, which was vol exploded 4 times faster than the price trend went up. And then all the people who were holding at the top were the loose pants trend followers. And that was their blowout year. But you would know better than me. I mean, what was the drawdown they had on Cocoa in their P&L when it went back to earth?
Oh, it was like 40%. They were holding over 100% of the value of their funds in Cocoa, the guys who got it.
Right. And so they have this enormous return, and hopefully no one was buying into the fund at the peak of that return. The cost is, right, you're now holding enormous size. You're going to have this really big drawdown on the way down before your trend signals get you out. So again, I think there is an argument to be made for the loose trends systems, in my opinion, when you look at it from a total portfolio construction perspective. But I just don't think that's how the world really works when it comes to allocation.
And also, like, let's be really honest here. The guys running loose pants systems couldn't in a million years run a vol target system. They don't have the research department. They don't have the technical capability. They don't have the execution capability. Surprise, surprise, the guy runs a $100 million hedge fund from Google Sheet that has done for 20 years without modifying your system rules or changing markets. Surprise, surprise, that guy thinks that it's a waste of time doing anything else. because he can't do that. He couldn't even employ the talent to do it.
So let me ask you a follow-up question about volatility targeting, because one of the big battles is always around what is the volatility you should be running your program at. And I find what's interesting is the more purist people get about trend following, the higher vol program they want. And I'm curious how you think about what target you set for that vol level.
This is where I'm somewhat of a heretic. I'm one of those trend plus nothing guys. I think running a trend system at low vol is suboptimal for your whole portfolio. I think the big advantage of trend following, purish trend following, CTA style trend following, whether you're doing it volatility targeted or loose pants, is that it's extremely difficult to blow up. And not running it at a reasonable Kelly fraction, you're doing yourself a disservice. You can't spend sharp if you're trading your own money. And I only trade my own money. Actually, that's not true. Like, we trade other people's money. I use the returns from that to fund the development of the trend system, but my wealth comes from my own book. So I run most of my own money at 50 volt, but I have some accounts running at 90 volt. And that seems insane, except the advantage of high sharp comparatively with crypto is that you're wrong quicker. So I think it was the Finnish guy, Marty, who was on your podcast. So 4 Kelly is sharp squared on 2. So if you think your real sharp is 1, then half Kelly is 50 volt. And your sharp in crypto trend is a lot higher than 1. But I think that leaves you a safe margin for error. And for me, 50 volt has been really good. It's been like 93% CAGR over bull and bear markets, made money every single year at sharp 1.7. I mean, that's what it's been for me at retail level cost.
I want to take the conversation from this theoretical level down to an operational level, if you'll allow me, and talk about exchange selection and execution and T costs. Really curious how you think about venue selection. I'd love for you to comment on decentralized versus centralized exchanges in crypto, transaction cost consideration and slippage, and trading certain cryptocurrencies on certain exchanges and others elsewhere, and the idea of who's on the other side when you're trading at different venues.
Yeah, this is really interesting. So I think it's axiomatic that you should trade at the highest liquidity venue that you can for any sort of style premium, risk premium harvesting sort of proposition. So we trade on Binance, Bybit, DYDX version 3, DYDX version, which has been sunsetted, DYDX version 4, KuCoin and BitGet, and about to start on Hyperliquid. And Binance and Bybit are clearly superior. I have high hopes for Hyperliquid. So in general, risk premium harvesting works better on high liquidity venues. But any sort of price inefficiency strategy, so we have some stuff that we trade on, some other non-trend stuff, some carry trading strategies and dirty carry trading strategies that we trade on really fourth-tier garbage venues. The garbage are the better, because any sort of price inefficiency strategy is going to work better on a trash exchange than a good one. So you see certain things, for example, we run a thing we call the dirty carry trade, which is going long the 5 coins with the highest positive carry and short the 5 coins with the highest possible negative carry. And hopefully those two are roughly balanced out. It's a dirty hedge, so we call it dirty carry. And that used to work a long time ago on Binance and FTX in 2020, and then stopped working on all the good places. And when Hyperliquid opened up, it worked really, really well. And now it works really, really well on some other even progressively crappier exchanges than that. So as far as execution goes, as long as you stick to the big stonkingly obvious stuff, like your execution doesn't have to be great. But your execution, the further you go towards stat arb stuff, the further you go towards cross-sectional strategies, the better your execution has to be. Because the idea with cross-sectional momentum is I'm not taking any market risk. I'm holding 50% longs, 50% shorts, and I want to stay balanced. And hopefully the long stuff goes up more than the short stuff goes down. And if your execution is poor, that's going to get out of balance and out of whack very quick. And then you're taking unintended exposures, which is wrong. So if you're talking about straight trend, your execution can be terrible. You could trade trend with a potato. As soon as you go from something beyond trend to something more sophisticated, you kind of have to pay a lot of attention to execution and venue.
I want to stay on the carry topic for a second. In crypto, and particularly during bull markets, we see this really high cost of carry for levered positions versus what we see in traditional markets. I mean, by comparison, we're seeing really abnormally high cost of leverage, cost of financing embedded in S&P futures today. And it got up to like 120 bips above SOFR, right? And for anyone in cryptocurrency markets, that's like laughably low. What are the high costs of carry for these levered positions? Tell us about the ecosystem. Tell us about the participants. Tell us about the opportunity for cash and carry or these dirty carry strategies being profitable.
If we talk about what makes crypto crypto, the first thing that's really obvious is that there's friction on getting your money in and getting your money out. So the tendency is that the money stays within crypto as a whole and also within chains. If you've ever had to get money from Solana chain to AVAX chain or whatever, you'll be slitting your wrists. It's so awful to do that once liquidity comes into one chain for an external event, like, for example, Trump launching a meme coin, that liquidity should slosh around, creating excess waves of liquidity, pumping and dumping random and semi-random coins for a little while. How is the carry rate decided in crypto? They trade these things called perpetual futures, which will your users know about perpetual futures?
I think most of them would probably understand perpetual futures.
Okay, so if you understand perpetual futures, the carry rate is set by the differential between the spot and the futures price, and they should converge. When that blows out, it's usually because someone is running some sort of crime or doing some sort of exit scam, or the tails of carry get very weird. The left side of the tail, negative carry, is a lot better behaved than the right side because it's hard to monetize the short side. It's hard to monetize the left tail. Sorry, that wasn't great. So carry rate is quite sticky, as in today's funding rate is quite predictive of tomorrow's funding rate. So you can earn a basis, as in going long spot, short the futures, which is something I do in my personal account, and earn that basis. Now, this is one of the areas where small crypto traders have a huge advantage. You can easily target 400 to 700% carry trades in capacity constrained markets, small shitcoins. And that's because lottery ticket bias, people desire for leverage. They're willing to pay more for leverage for Trump coin or whatever garbage trash coin of the day. And you can monetize that. And as long as you can keep it delta neutral, you can earn a lot of money doing it. And that's probably a great place to start for a retail trader. There's also very interesting funding arbs between venues. And the funding arbs between Hyperliquid and Binance have been good. Between Hyperliquid and fourth-tier trash exchanges are very, very good. So you can get on delta neutral trades, not with a great deal of size, but if you're a home trader, this stuff is incredible.
You mentioned crime. And on Twitter, there have been several times where you've posted a chart where that'll have the spot price versus the pricing of that perpetual future. And all you'll put in the tweet is, it's crime.
It's crime.
It's always crime. And I was hoping you could talk me through specifically these examples, right? What are you showing when you're showing the perp price blowing way out from the spot price? Why do you think that's crime? And then more broadly, taking a step back, how do you think about crime and rug pulls as a unique idiosyncratic driver of behavior in this market?
Oh, this is where it gets super interesting. Let's talk about what we would call the vanilla model of crypto crime that almost every VC does. Is since time immemorial, they've invested in startups at $1 to $5 million market cap, and they've used their contacts to get them listed on exchanges and create fake-ass communities around them and get some buzz and get a bunch of retail guys FOMOing in to become exit liquidity. And you've got this situation where a VC or a seed investor or a founder will have a 100-bagger or a 500-bagger on paper, but the liquidity in crypto is largely an illusion. It's like that thing that Nassim Taleb said, like, an idiot focuses on the size of the movie theater and not the width of the door. And the width of the door in and out of crypto is very, very narrow. So, for example, I personally and permanently on purpose wrecked for all time a $1 million market cap meme coin recently with a $4,000 sell. That's the level of like $4,000 can nuke something for all time at $1 million market cap. At $100 million market cap, you'd be lucky to get 300 or 400 grand out without materially affecting the price. So we know that the spot price and the futures price should be coming back into alignment at various predictable intervals. Otherwise, there's an arb, and someone should be closing that up. If you see that arb not closing and in fact blowing out, the only possible reason for that is someone is just dumping with both hands. So what happens is the classic model of crypto crime is when the derivatives market gets bigger than the spot market. You can walk the spot market up with some judicious, fraudulent market making, which isn't illegal like it would be in TradFi world, right? In fact, that's a very important thing to notice, like, especially with the Trump administration, we're making crypto stuff illegal. Like we've outlawed crime in crypto. Like everything's on the table now. So you can get a market maker to walk your spot tape up while you're selling in size on the derivatives market, in the perp futures market. And that's the usual model of gaining exit liquidity. Because if you think about it, everyone can follow your wallet. Everything's public. So you're a founder, you've got 100 million coins in your wallet. Everyone's tracking that wallet. The coins I'm in, I've got alerts on all the top holders. If someone starts selling, I want to know. So if you want to sell, if you want to get out, you have to hedge first in the derivatives market. And when someone does that, this is price insensitive trading. And price insensitive trading almost always has edge to it, right? If you see for sure that the owners of a coin are dumping their whole stack in size in the secondary markets, you can pretty much say that that coin is going to have a lot of problems going forward. Like that's a good short. You're looking for price insensitive flows, and price insensitive flows could be on the long side or the short side. In most markets, you see crime and you rush the hell away from it. In crypto, I see crime and you're rubbing your hands together and you're racing towards the crime. So, for example, North Korea hacks some exchange. The first thing they're going to do is go to Thor chain, the crime chain of choice. They're going to try and bridge as much as they can into something semi-anonymous or hard to track or hard to freeze, and they're going to try and get it out as best they can quickly and get it to that Cambodian fraud exchange that doesn't care. And this will push prices. A price-insensitive seller selling as much as he can in the 15 minutes before his wallets start to get frozen really doesn't care that much about price. He's probably going to trade at bad prices. So like when you see North Korea doing a hack, you want to sit at the screen. You want to be on the other side of North Koreans because they're going to be selling at bad prices. And this goes through to meme coins as well. We talked about there's negative trend effects with the small coins, right? And meme coins are the smallest of the small coins. So not only is there negative trend effects, downstream of that, when a chart guy sees a trend on a chart, what he's seeing is momentum. But if we know that not only do we not have momentum, but we have negative momentum, and if you see a chart that looks like this perfect bull flag or whatever on a meme coin chart, a small one, not one that's listed on exchanges, you know that that's artificially created. That's something that does not happen in nature at this market cap and size. And you can almost bet that that's crime. And when you see crime in crypto, you want to either trade against it or trade alongside with it, depending on how much it's got to go. And so with meme coins, the play is finding things right now. One of the things that will absolutely take your sanity, but it's very easy to do, is to find a meme coin chart that is being shilled by everyone on Twitter and have nothing to do with it. Just look at the wallets that buy and sell it, and you'll find the same three wallets buying and selling the next one. So you see a successful wallet and you get in on the next play before it. And as soon as you see them starting to support the tape and make it look like a beautiful work of art, they're spending money to commit a crime. And that's when you want to buy, and you want to kind of have a rough guess where they need to get out to make money and ride along and jump out before they get out.
So let's stay on this meme coin, shitcoin phenomenon that sort of took off and was pervasive in 2024, continues to be pervasive into 2025 here. A lot of people call it the trenches, this whole pump fund on Solana situation that's happening. For people who are not paying attention to crypto markets, can you first explain what is actually happening here? And then can you talk about, you started to talk about it with the crime, but I'd love for you to expand. How do people actually find edge in this market that appears to be, from the outside looking in, nothing but degenerate gambling? There's no fundamentals. This isn't tied to anything. There's no real value. It is more or less just pure supply and demand randomly driven.
And worse than that, because the fees are so high and so extractive, and it's obviously a net negative value for the world type situation, right? So how do you find edge when there's a really strong house edge against you, right? So it's probably a good spot to talk about what causes the EDO of crypto markets in general, and then get into memes. So we've got sticky capital in crypto as a whole, but within a chain. So once a little bit of capital gets into Solana, it washes around and creates further meme coin pumps. And so we saw that last year with Bonk and then Dog with Pat. that created 1,000 meme coin pumps, just the residual liquidity frothing around. And so what that means is that a small amount of, for example, capital flowing out of Bitcoin into Solana chain, and those are two separate things. Like, it's not all just crypto. To get it back out is such a ball ache that it generally doesn't happen. So it froths around and creates this illusion of massive liquidity, which isn't true. And so the upshot of that is that anyone who's smart realizes that you have to take the liquidity while it's there, because it sure as hell won't be there when you want it. The next thing that we've got desire for leverage and things with lottery ticket-like characteristics. And you see the situation where we're wired for story much better than maths. And this story of the bonk guy put in $500 and now it's 8 figures, and he held through multiple 8-figure drawdowns and bull posted it the whole way. And he went down from $10 million down to $2 million, and now he's $50 million. And like, that story is a human story that we're wired to. And this is the beating heart and soul of crypto. Like, whenever you see the little guy gets a win, that's something that you can bet is an idea virus. It's a virus that spreads. And I've tested this, like meme coin trading, when I introduce my non-crypto trading employees to it. It's addictive like crack is. So the next idio of crypto is that we've got really small on-off ramps. So it's like Hotel California, you're always up at the casino, but you can never stop playing. And we've got price-insensitive behavior en masse. We've got people buying Trump because they like Trump. We've got people following Cole, following influencers, and we've got people who are making their identity tied to a cult. So I'm part of the XRP army, and anything that you make part of your identity makes you stupid, and you've got price-insensitive behavior. The next thing is we've got our wallets are public. So, for example, I'm a large holder of a meme coin called Retardio for a bunch of, you're going to laugh, but I'll say fundamental reasons. If the other whales in Retardio saw my wallet start dumping, I'd have some questions to answer. They would absolutely know that, like, wallets are public. And after that, the desire for exit liquidity is the biggest, overwhelmingly the biggest idio of crypto. It's the desire. Crypto people might seem stupid, but they're not stupid. We know that this picture of a dog with a cute hat on it is not worth $3.6 billion. Like, intuitively, everyone knows that that's a delusion that is going to come crashing down to earth at some point. So everyone knows, and everyone is going to take the exit liquidity when it's on offer. And when the retail exit liquidity arrives, they have to take it because it's not going to be there. And so what this leads to is, because we don't have proper fundamentals, you've got friction on the way in, friction on the way out. Positive feedback loops can abound, which is why momentum and trend effects are so much stronger. But it's also, altcoins had 98% average bear market in 2022. Like, it's just like the bear markets in altcoins are just horrific. And so to a large degree in previous cycles, VCs just took the piss and founders took the piss. It was hugely extractive. 80% of people who traded crypto lost money over time. It's just a hugely extractive, like, all the criticisms of crypto are absolutely valid and true. And so meme coins are a reaction to that. So instead of this sort of fake ass governance token, and we've got all these complicated mechanisms, which are basically, most crypto variations are trying to get the rules of the crypto token as close as possible to a Ponzi flywheel. Because we know that Ponzi's go up and blah, blah, blah. And you want to make it as close to a Ponzi flywheel as you can without going to jail. So instead of that, like Ponzi flywheels and mutating variations, we go straight to what's the true product market fit of crypto, which is people just want something to bet on. Like, let's bet on it. People want to bet on a $2,000 or a $5,000 asset. Like you were telling me before the call, your friend pulled 8 figures out over the weekend. Little guy, hero, champion. Cheer for that guy. Anytime you see that, you know that people are going to get interest. And memes do that in a way that's really unpretentious, without any of this fake Mark Andreessen, it's the future of money and the future of technology. And it's a way that a normie can get. Oh, it's a dog with a hat on it. Cute. Oh, Doge. Oh, they called the new department Doge. Ah. We're wired for story, and those stories are much more spreadable or mimetic than someone telling you, oh, here's a sharp 3 strategy for crypto. A much better story is this guy turned $1,000 into 10 million and he's retired his bloodline.
It's hard to not be cynical about that, though, because it is ultimately zero sum. And you say that the pure product market fit is just betting, right? And gambling. And I'm sure there are people who are ultimately dismissive of crypto. So I want to contrast that and bring this way back around to something you were saying at the beginning of the conversation, and something that people who are pro-crypto talk about a lot, which is the decentralization of finance. And I want to talk about this idea where you were saying you might be able to take your trend program and create a vault on the hyperliquid L1 and allow anyone to allocate capital to your program without KYC. For people for whom 9 out of 10 of those words didn't make any sense, I was hoping you could quickly explain what is it and why it's such an interesting opportunity.
So let's compare having an account with, say, Coinbase, with self-custodying of your own coins. If I have an account with Coinbase, I hook my bank account to Coinbase, I buy some Bitcoin. Coinbase holds my Bitcoin, and I have to trust that they don't ban my account for some reason or put a block on it or whatever. In DeFi, I'm taking responsibility for my own coins. I'm having my own wallet, and that wallet is not tied to my email address, my address, my nation. It's just an address. That address can hold coins. You can dump those coins into what I'd like to do, what I am doing actually, is there's a new layer one, which is a new type of blockchain called Hyperliquid, which is a very, very fast, high-performance blockchain. It's the first one that's high-performance enough to have an order book in the blockchain. And it's got a bunch of order book primitives built into the rules of the blockchain. So you can do basis trades, you can do order book stuff. All of my trend features will go straight on there, as well as basis trades and carry trades and all kinds of stuff. It's a very, very great way of starting it. I don't want to say the HF word because then I'm in legal territory. It's just a smart contract. You can put money in, you can pull money out. It earns what the trend system earns. You don't have to trust me when I say that my trend system returns X amount per year at X value. You can just look it up on the blockchain. It's all public knowledge, so I can't lie about my track record. You've got instant liquidity. You don't have to tie your name to your wallet. And the big advantage of trend in crypto is that it's non-correlated to regular trend. And that if you try and do TradFi trend as a retail trader, even with $500,000, you're going to find problems just because of contract sizes. But you can run with $2,000. You can run quite a diversified crypto trend following program. So it's perfect for retail. I'm a retail guy at heart. I'm not a sophisticated guy. I'm a retail guy at heart. I want to see the little guys make it. And in my view, a little guy who's got a small amount of money in crypto should be cranking his vol up and taking some risks and getting paid for those risks and getting paid for all the distasteful nature and all the bad stuff that happens in crypto because it won't last forever. Crypto is basically speed running every financial panic and everything that the traditional finance world figured out in 1880 or so through 1929. Like every single grifty barnacle attached to TradFi world that we've seen in crypto. You go back in time 100 years and crypto guys are just too smart to go read a history book and figure out, oh yeah, people have tried Ponzi flywheels before. People have tried banking panics before. People have tried fractional reserves before. People have tried all these scams before. And any new technology has a grifty barnacle attached to it. When the internet came, and I know this because I was there, the internet was 90% grift at the start. And so it's a mistake to look at crypto as being this scam because crypto was a scam. Bitcoin's been going for 16 years. But let me tell you an awful story. I sold 1,000 Bitcoins at an average price of $23. Awful story.
I don't think that's as bad as how much did the guy pay for the pizza in Bitcoin?
Oh, yeah.
I mean,
this is terrible. And, at the time, you couldn't do anything with Bitcoin. And I needed the money. I needed the money to live off. You just couldn't do anything with Bitcoin. It went from $4 to $32, and it looked like it was going straight back down to $1, and I sold. I panic sold. I had 9 Bitcoins left, and thankfully I got those. And then an exchange, Mt. Gox went bust and stole them, and I just got them back. It's a mistake to view it as it was when every year it gets a little bit more legitimate. Bitcoin's been running for 16 years. It's never been hacked. It still works exactly as functioned. Like Bitcoin is not really useful as money because it fluctuates in price so much, but it definitely has a use case. Like I live in Phuket, Thailand, and my little village in my little island is overrun with rich Russians who get their wealth out entirely through stablecoins and Bitcoin. They don't have access to credit cards. They don't have access to Swift banking system. And in my street, there's 5 little air-conditioned kiosks that look like street food noodle stands where you can walk up and transfer some Bitcoin and they'll give you a sack with $100,000 in cash in it. Like this is just by the side of the road in an island in Thailand. And so is that a good thing or a bad thing? Well, if you had to pick use cases, Switzerland's done pretty well out of money laundering and tax evasion over the last 500 years. Like, I think the base case is that Bitcoin has a use. What percentage of global finance? Worst case scenario, it's a small but significant fraction of global finance. And my personal opinion is that this year was the first time that you could really say for sure that there's no second best crypto. I think that was open to debate until this year. I don't think Bitcoin's going away anymore.
What advice would you give to a new retail trader getting started today?
Okay, so as a new retail trader, if you think you have edge in the FX markets, you don't. If you think you have edge scalping NQ futures, you don't. Grow up. Like, seriously, grow up. You need to find a way to make money today with the skills, the technology, the infrastructure that you have today. Now, you might want to have $10 million in capital. You might want to have a team of devs. You might want to be good at maths and be able to program. And so the classic nerd thing to do is to put that day of reckoning off and just learn stuff. And you'll end up starting an undergrad quant Substack and being a fake person. The way to get into it as a retail trader is to find the easiest possible poker table to sit at. By far, the easiest tables to sit at are in crypto. And then you want to find what you can make money with today. So if you were coming in as a brand new trader today, I wouldn't think you would be able to understand the idiosyncrasy of the crypto market at a deep level. I wouldn't think you'd be able to compete with me in identifying on-chain crime and monetizing it before people got out ahead of you. I wouldn't think you could do any of that. I would think that you could do simple trend strategies. I think you could do simple carry strategies. I think you can do simple basis trading strategies. And those are phenomenally profitable. You can target over 100% a year compounding in crypto as a retail trader, as long as you're, not trading size. And that's what I do. And then learn more and learn by doing.
Last question for you. It's the same question I'm asking every guest this season, which is to tell me about what you're passionate about today, outside of what you do for a job. Books, movies, music, something that's really caught your attention and your passion.
For me, being a CEO of a company has meant that I've had to narrow my focus significantly. So I have a bunch of hobbies, like I'm a lifelong martial artist. I'm a Brazilian jiu-jitsu. And the position of my hobbies and my interests and everything in my life has had to come down to I have CEOing, and then I have enough stuff to keep me healthy. And then periodically, seasonally, I trade. So I don't have much of a life, to be honest. I've got a 4-year-old daughter, and that's the thing that I'm really passionate about, and my family. And I've got a beautiful Labrador and a couple of nice kitties, and we live on the beach in Thailand. It's a nice life. And I mean, because you're building a company, like I'm building a company to sell. And it's a very, same as you. We're fellow travelers. I get you. And I've got a lot of people riding on my judgment. And so I feel the weight of that quite heavily, to be honest.
Well, Scott, this has been phenomenal. I really appreciate you taking the time to dive into these markets. And I know that the listeners will have gotten a lot out of it. So thank you.
I've really enjoyed it. And yeah, I'm a huge fan. And yeah, I'm not a well-wisher, I'm a fan. So excellent.